So 17th of July. And damn it, if I didn't think today was Thursday. So, and then on top of that, quite a few technical difficulties here. A lot of things not wanting to work. So going back to this particular system, see if I can make this one work. The other one was working, not working, was working. I don't know. It gets to a point where you can't fight it because it just sucks up the majority of your day. So let's talk about the bonds real quick because I am rather behind right now. So let's get you guys some data on what's going on here. So let's look back here as what's been going on. And of course, the main question everybody's going to give me is, did the mortgage rates improve this week? And that's still the wrong question. The better question is still going to be is, what changed the return investors demand to own my mortgage? That's always going to be the main question, because this week gives front row seat to the price of money and how it gets traded right in here. Friday afternoon, the bond market started getting very defensive on what was happening. That's right here, right? And they started preparing for the inflation reports that are going to come out. Mortgage-backed securities weakened a bit. Yields moved higher. And the Monday fuel prices came out, and they continued to push the inflation fears. As we saw, it pushed it down, got that erosion. And of course, the investors, those who are putting money into the mortgage-backed securities, were saying, if we want more money because of what's happening with inflation, eroding our dollar that we'll be receiving back, which is a flat rate of return. Then Tuesday came and everything changed. CPI, bam, sucked up all that loss. Just that consumer price index showing things were a lot weaker than they had anticipated. Inflation was not what they thought it would be. Then, of course, you get the producer price index comes in, and now we're sitting here at this point. Again, look at these levels that we've marked out in the past. They keep hitting on these things. It's something that we can kind of reasonably predict. So now that we have that, we're going to see what ends up happening. If there's anything that comes out to kind of show for inflation a little bit weaker, if it is, we'll go back up in here. If we get to the point of where they're going to talk quantitative easing, we'll get up in here. But that's really where we're at right now. We've got bond traders saying, that's where I need my revenue to be. If I'm going to put money in for 30 years and wait on the return, you're saying, hey, I'm going to grab this because it's still extremely cheap considering everything. And I get to secure an asset that's going to appreciate. It's going to compound as far as my rents. I'm going to get their tax deductions, and I'm going to also get my amortization. All of that helps you, not them. Their money's flat, and it's subject to the market. Once they trade, they're in it. Once you trade, you're in it, but you get all the other things to work for you. So quit jerking off. Let's make the trade.